Welcome back everyone to Core FX Series Part 2. In this part we will go through one of the most important, and probably the most misunderstood and ignored topic, and that is the volume. In the FX market, just like the other financial markets, volume is the real factor that makes the price move. In simple words, low volume equals slow price movement, and vice versa. Since Forex is a very crowded and complex market, it is almost impossible to gather 100% accurate information regarding volume, so tick volume can be used as indicator of volume. It means that tick volume measures the number of times the price ticks up or ticks down. Every broker provides tick volume, and it is considered to be the best possible proxy for real volume, since correlation is over 90%. Unlike market news, rumors, or lagging technical indicators, volume can't be faked and can't lag behind. It is simply showing the real demand on the market. So, if something is over 90% correct, it only can be very useful. That's why I use it as a part of my analysis. There are few ways you can use volume in your analysis. The most logical, simple, and well explained are the Wyckoff methods. Studying and understanding these laws can be very helpful for every trader. The law of effort directly links to volume analysis. It says a widespread move should be supported by high volume, and vice versa. You can use this knowledge to analyze the candle moves, along with technical and fundamental analysis. In next few pages, you will get a better insight about this. You can think of volume as a fuel for the price. By the theory, candle reacts to volume by effort. This means that candle spread is likely going to increase as the volume increases. On the left side, you can see candle making higher spread, going along with high volume, which confirms the law. On the right side you can see vice versa case. But, things are not always that simple, especially in the Forex market. In this case you can see how sometimes price doesn't react to volume accordingly, but in an anomalous way. On the left side, you can clearly see an example of low volume, high candle spread relation, and high volume low spread relation on the right side of the screen. This means market didn't respond according to volume flow. There are many potential reasons why that happens, but we should focus on market reactions before and after this event. When price movement deteriorates from volume by notable amount, market usually makes erratic move, and this anomaly can be used as an early alert. On this picture you can see more examples of candle to volume anomalies. On the far left and far right sides of the screen, you can see volume to price validation and anomaly. In the middle, you can see an example of price breakout with increasing volume. This means buyers have stepped up and overpowered sellers. But, after some time, price has to retrace back a bit. On this example, that retracement is followed by lower volume, which at the most cases means that buyers are taking out their positions, and as soon as the profit taking is done, there are more chances price will continue with the trend, along with new wave of buyers. During lower volume on pullbacks, price will move slower and give more opportunities to new buyers on the market to enter. If trend continues its way pushed by increasing volume again, this usually means second wave is starting and the most recent resistance level will not hold. But, if price starts to go the other way followed by continuous high volume, this usually means there are more chances price will pull back all over to starting spot, even change the trend. High volume on retracement means that sellers are back on in the game, and there are just few interested buyers this time. On this session breakdown, we have multiple volume to price spread examples. Looking from the left to right, candles start to increase along with increased volume, right at New York session. This results in support breakout and downtrend. After that, volume decreases as we move to Asian session, candle spread narrows, and that is validated by price action. After the Tokyo session failed to change the trend, price is likely to continue with downtrend. That is exactly what happens, right at European market. During most of the European session, price was continuously falling down on increased volume and bigger candle spreads. However, right at European session's close, while volume was still moderately high, candle spreads started to narrow, signaling an anomaly. The end result was price retracement and temporarily trend change. What you can spot, by analyzing sessions day by day, is that volume to spread is usually well correlated, but when it's not, that can be used as quality indicator of potential changes. Whether looking at candles solely, or looking in the overall market context, this knowledge can help you to make better decision either to join the validated move, or to avoid potentially fake one. Thank you for watching, and see you in next episode.